Hello everyone, welcome back. My name is Give Moma Goodju here, and so we are now progressing, and I hope you have been practicing. The way we projected the consolidated income statement for Simbisa Brands. So in this section of the course, we are going to look at how to project the cash flow statement. So without wasting time, let's dive right into it. So the cash flow statement mostly is a representation of how much cash a company is produced or spent over a specified period of time. So it is divided into three key categories. We have got the operating activities section, which is in a way is a way of reconciling the net profit. We are trying to see that from the profit that the company reported, how much is actually cash, okay? Because in most instances, a company might be profitable, but at the same time might not be producing positive cash flows, or might be having some cash flow challenges. So it's a way of reconciling to find out how much cash did the company actually make from the net profit. So operating activities is a representation of how much cash a company is made from the profit that it reported. So we take profit sometimes in some balance sheets, in some jurisdictions, like in the US, where it's written profit before tax. We may start by, you may see their written net income, and then we add back depreciation in the other non-cash items, and then we also take into account changes in working capital, and then we get to the actual cash produced from operating activities. And then we see that this cash was also used to finance some, purchase of property, plant, and equipment, either for expansion or, maintaining the operations of the business. So here, as you're seeing under investing activities, we are looking at things that the company is investing in, or projects that the company is investing in, that meant to make sure that the company keeps on growing in the future. So here you can see in row 32 that we have got purchase of property, plant, and equipment for expansion. So that is really key, because if we look at that, we call that capex, right? So those are investments in future projects. So the higher rate of capex investment may mean that the company will continue to grow in future, or will continue also to create value for the shareholders in future. And then we've got purchase of property, plant, and equipment to maintain operations. So this is mainly to sustain the existing infrastructure and service systems, to make sure that the business keeps on going. And then we've got proceeds on disposal of property, plant, equipment. This is the selling off of some out or old equipment and property and plant. And we've got also disposal of financial assets, disposal of subsidiary, investment in financial assets. This could be investments in securities such as stocks, bonds. That also can include maybe investments in money market instruments, things like that. And we are seeing that there's also an element of purchase of investment properties. And also acquisition of associate, something like that. So basically that's it in the investing activities. So we mostly look at acquiring assets and disposal of assets, and also acquisition of equity interest in companies. And then we've got financing activities. So here we find normally items to do with issuance of equity, capital raising, right? Issuance of equity, retirement of debt or issuance of debt. So and also payments of dividends, right? So we are seeing that as well. And we also, there are some items to do with share buybacks that you may also find here. So here we are seeing purchase of additional interest. This is a purchase of a minority interest in Inbox, right? So basically that's it for the cash flow statement. Now let's look at how we can project it. So now we want to link the profit before tax from the income statement. So profit, which is earnings before tax here for 2024, and then we copy that to the right. Now depreciation, we're going to leave it blank for now. And then derecognition of property, plant and equipment, we have no idea what this is, so for now we just keep it at 0 until we get sufficient information to project it. Then we can project. Then gain on bargain purchase of associate, we have no idea about that. Gain on purchase of, we have no idea to project that. And that loss on disposal of property, plant and equipment, we are not quite sure whether the company will sell some assets in 2024. So here we keep it at 0. So here we just copy that to the right. And here we've got amortization of intangible assets. Let's just keep that at 0 for now. Then we have got fair value on loss of investments. Let's just keep that at 0 for now. And we have got interest income. Let's just keep that blank. And interest expense, let's keep that blank. Let's just keep that blank. Loss on disposal of subsidiary Namibia, let's just keep that at 0. And leave pay provision, here we also don't know. We have no information on how to project that. So we have to go back into the annual report and research more about leave pay provision. For now, let's just put that at 0. Right, let's just copy that. And changes in working capital, for now let's just leave that blank. Let's just leave that like that. And let's move down to the investing activities section. So let's create here, and then we say capex as a percentage of revenue. Okay, capex is a percentage of revenue. And let's just do the same here. Capex is a percentage of revenue. Right, so basically if you are building a financial model for valuation purposes, it's recommended that you project out the income statement, and in the cash flow statement you project depreciation and some other non-cash items that are recurring, and obviously you need to project changes in working capital. In other investing activities, you need to project capex, and you will be done. But for the purpose of just showing you how to build a financial model quickly, I'll complete up to the debt schedule so that you have an appreciation, even if you are required to build a financial model of a certain institution or of a private company. That will also help you a lot. So here, let's just divide that by revenue for 2022. So we divide that, and then, and here we do the same. We divide that by 2022 revenue, and then we just do the same. Right, so here we need to project, right? We need to make an assumption, right? But before we do that, like I said, Good financial modeling etiquette requires us to turn these hard-coded numbers into blue so that you won't get confused. So let's just turn that for a moment, Alt A, and then we click that, and then we press F4, 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 right? Then press escape. Right, so here for now, let's just project that since Simbisa is on an overdrive and is taking an aggressive approach, so let's just keep that at 8%. So let me just turn that into a percentage. So we're going to keep that at 8% for now. So let me just highlight that, and then here we just keep that at 3% for now. Right, so let's just keep that at 3%. Perfect. And then let's project that. So we're going to say negative, select this, and then multiply by revenue for 2024. Right, multiply by revenue for 2024. So here we put a 0, here 0, here 0, because here obviously net cash, that won't, okay, unless we get information telling us otherwise. Then proceeds on disposal of property, plant and equipment. Proceeds on disposal of property, plant and equipment. For the time being, this is not of great importance, so we just put that at 0. The disposal of financial assets, we don't have info that the company is going to dispose. Even this one, it's so here, and we also don't have information that the company is going to dispose some of its property, plant and equipment in future or in 2024. So here let's just audit our formula here. So to audit, I said you press F2. So here we are seeing that our formula is not working, so we have to change it. So we have to change that. Right, and then we copy that to the right. So if we now audit the formula, you will see that it's now working. Okay, so let's just ignore that, and here purchase, this one we just put it as 0, and then proceeds from borrowings, repayments, lease, these ones we just leave them at 0. Then dividends paid by subsidiaries, dividends paid by subsidiary to non-controlling interest. This one is a difficult one. It's a difficult one to project. Then is for now we are just going to project dividends paid by holding company. So we are going to use the dividend payout ratio, right? So we're going to use the dividend payout ratio. So here we're saying dividend payout ratio, that's a percentage there. So we just come here, and then we divide dividends by net earnings, which is this one, and then we do like this, and then we turn that into black. Okay, So here let's just put it at 40%, just an estimate. 40%, so 40%, and it's a hard code. And then here let's say negative multiplied by, we take the adjusted net profit for, and then we just right, just like that. And for the others we leave them blank for now. So let's just audit our formula as well. You will see that it's not working, so we need to change the formula. So we need to say this plus, like this. Perfect. So here let's just ignore that. Right, so here we can even put it 39%. Okay, 39%. Right, so now we want to project depreciation. So there are two ways to project depreciation. We can even take depreciation as a percentage of revenue, which is the easiest one. Okay, which is the easiest way to project depreciation. So like I said, like I had promised, that we have got a depreciation schedule here. So we are saying property, plant and equipment. If we look at historical depreciation here, so we've got amortization of intangible assets, we have got historical depreciation here. So what we want to do is, we are saying so let me just quickly go back to the annual report. So I want us to go to was depreciation, that is 15, not 15. Not 15. So it's telling us about the depreciation thing. Okay, so let's just try to look there. No, I think we have to find ways giving us a breakdown for revenue. Let me see. Okay, depreciation, where is depreciation here? Okay, so the other way you can do is you can press Control F, that's Control Find on your keyboard. Seems it's not working. Okay, so just let's just give you some time. Okay, so here we write, so let's write depreciation. Right, so here we've got depreciation. Okay, let's keep on searching more about depreciation. Depreciation. Okay, so if we press previous, you see that we have got depreciation for right of use assets, and we also have got depreciation for, what do you call it, property, plant and equipment. Okay, so that has been aggregated in the income statement. Okay, so let's just go back here. So what I'm gonna do is I'm going to come back to the balance sheet. Okay, So I'm going to come to the balance sheet, and I'm going to so we've got property, plant and equipment, right? So we've got depreciation. So our property, plant and equipment figure must include the balance for the right of use assets as well. Okay, right of use assets. So to do that, we are going to, for now, let me just press enter here. So what I want to do is I want to just go back to the balance sheet. Here I'll press equals, and then I'll press plus this figure here. Perfect. And I'll also come here and I'll say plus this figure here, and then I will remove the figure 4. I'll remove that. So let me just do that, and then I'll press Alt ES V, that's value. Right, so even if I delete this row now, the balance sheet will still be okay. Okay, so what I've just done here is I've added together the balance for right of use of assets and the balance for property, plant and equipment together, since the depreciation that was charged in the income statement was for intangible assets, property, plant and equipment, and also right of use of assets. So to avoid confusion when computing depreciation using a depreciation schedule, I've just added together the balances. So here what I'll do is I'll just select that, and on capex I'll just put it negative here, and then I'll go to the cash flow statement, and to the cash flow statement I will choose this. I'll say this plus this. Okay, and then copy that to the right. So if I go back, that's not reflecting the correct figure here, so I'm going to repeat that. So I'm going to the cash flow statement, and then I'll say this plus this. Now this makes sense. So let me just start again. Okay, so let me just start this again. Okay, let me just start this again. Right, so here we have linked through the capex. We've linked to the capex from the cash flow statement, right? So there's also a way to link the same, but in making sure that it remains a positive. So that's the formula that I'm looking for here, because right now it's in negative. I don't want it to be in negative. So here what I'm going to do is I'm going to press negative here, or what I can do is I can just say go back to the cash flow statement, and then I say negative here. I think that's the correct way. No, that's not. So let me go back again. So I'll say negative, and then cash flow, and then I say negative. Perfect. So this is the formula that I've been looking for here, that brings the figures in a positive way. So here I've got these years that I've put here. So you can find these years here just in the annual report. So if you come here and then you say useful lives, right? So here you press, so then you come here. Okay, so here they're saying leasehold improvements, law of 20 years and expected remaining, planned equipment 12 years, office equipment 5 to 10, motor vehicles up to 8 years, something like that. So I just took I kind of took the average of these three here. So here I came here, and then what I did is to compute depreciation for the property, plant and equipment is I took the property balance here, and then I anchored it by pressing F4, and then I divided by the property, plant, useful life, which is this one, and then I copy that to the right. So this is straight line depreciation method. It charges uniform depreciation across. And then here I also took this one for 2024 capex, and then I divided by the useful life. And then here I took this, I divided it by 10, anchored that, and copied that to the right. And I also did the same here. I divided by, and then I copied that. So here I'll also do the same and divide by the useful life here, and I'll also do the same here, divided by, and I anchor that. Right, so here I'll add the total depreciation here. Right, so here I want, so here before I can take this, before I can link this depreciation in the income statement, I have to do a cross check. Okay, so a cross check, I found depreciation for property, plant and equipment plus the right of use assets. It grew by 10%. That's from 2022 to 2023. So I could as well be growing it by maybe 5%, you know, maybe plus 2% to this one. And the other thing is I can also as well divide this by revenue to find out the trend. So let me just try to do that now. So let me say depreciation is a percentage of revenue, right? So I can take that and go to revenue for 2022, and then you can see that it's at 6%. Okay, so it's at 6%. So which means since it's at 6%, I can actually make it 6% throughout here, just for consistency. Okay, mind you, this is just, you know, us just trying to find a near realistic projection, right? So here we are saying that this is too high because look at that, it has grown by 20%. So how best can we reduce that? Let's try to increase our useful life here. So if we increase the useful life, you will see that it has declined to 9%. So here I may want 10%, or I may say 10, and then here let me try to increase that to 11. that goes to 7, which is close to 6%. So I may even copy that across. Okay, so I may even copy that across, and here I can also copy that. So but we are seeing that it's still too high throughout. So how best can we control for that? So let's try to do this, or let's try to get back to 8% or 9%, and then here let's try to go 12% or 13. Let's find out with 13. So I think for now 12%, it's kind of giving us the rate that we want, around 6%, 6% here. And let's try here, or 15. Let's try here, or 7. Let's try here, 6. So 8, then 9. It's making sense. So the range is fine, right? So I think for now we can just link that through, and then we can come back later and play with our depreciation. We can play around with our depreciation forecast and estimates, right? So here we can come to the income statement, and then we say equals negative, and then we go back to depreciation, and then we link through depreciation, right? So under depreciation schedule as well, I took depreciation for property, plant and equipment plus right of use of assets. I didn't include depreciation for amortization of intangible assets. So the reason I did that is it's because of I just needed to take depreciation for operating assets, that is assets that produce income, that help the company produce revenue and income. Okay, so that's the reason why I did that. So we are going to come back to that later, but for now let's proceed to the working capital schedule. Right, so here we have got the working capital schedule here. So let's just total that. Okay, but I think before that we still need to go back to the cash flow statement here, and we have to link depreciation from the income statement. So we have to say income, and then here, and then we copy to the right, just like that. So here we have got unrealized exchange gains. We have no information relating to that, so for now we just copy that to the right. What else is left here? So we've got these three, okay, which is fine. So let's project these items here. So we are now here and in the working capital schedule. So here what we are doing is we have to project the working capital items, which are inventory, trade and other receivables, trade and other payables. So if we go back to the cash flow statement, you find that under changes in working capital, these guys only included inventory, receivables and payables. Okay, so in my working capital schedule, I even included income tax payable. I got that from the depreciation, from the balance sheet. We have got current tax liabilities. So I got interested to find out how long are these guys taking to pay their tax liabilities, and that I know also has got a bearing on their working capital. So that's why I included that in my working capital schedule. So these figures, I link them from the balance sheet, right? So I just go to the balance sheet under current assets, and then I linked through inventories there. And I also did the same for trade and other receivables. Trade and other receivables, I link them also here from the balance sheet. And the same for trade and other payables. So trade and other payables. So trade and other payables. Then income tax payable. So income tax payable, which is this one. Okay. So here we can just go back to the balance sheet, to the cash flow statement, and then here we can just say changes in income tax payable, something like that. Since we didn't have anything here, we just put a 0 there. So we have to our formula has to incorporate that change there. So we sum up all these items there. Right, perfect. So once we have done that, let's go back to the working capital schedule. So here we want to find out how long does Simbisa, how many days does it take to process its inventory. So here we are going to say average, right? So we're going to say average of these two, right, divided by negative cost of sales, right, for 2023 in the income statement. So here we find where the cost of sales for 2023, then we multiply it by 360 days, just for the sake of rounding. Okay, so here we say average, and then we divide that by total revenue for 2023 in the income statement. So here we come here, we multiply by 360 days. So on average, we are saying Simbisa takes about 28 days to process its inventory, and it takes on average 8 days to collect money from its customers, right? So let's just do the same here. Then we've got average, and then we divide that by negative cost of sales for 2023, then multiplied by 360, right? And then we do the same here, average, and then we divide that by would like to divide that by total cost, that is total expenses. So say negative, no, that one we won't divide by total expenses, but by the income tax expense. Okay, so for 2023, so we come here, we find where the income tax for 2023 multiplied by 360. So on average, it takes about 290 days to pay their income tax. Okay. Right, so now we want to project that. So for now, let's just keep that constant. Let's keep that constant, and let's keep that at 100, and let's keep that at 290. Okay, so here let's just turn that into blue since it's hard code as well. These ones, they are hard code numbers. So here, oh yes, then we format that, and then here right, and then here OTF, right? Okay, we format that, and then we format that as well. Perfect. Now, to find the balance for inventory for 2024, we are going to say 28 days divided by 360 days times the cost of sales for 2024. So here we multiply that, and then we copy that to the right, and then here we divide that by 360 multiplied by revenue for 2024, right? And then here we copy the formula to the right. We do the same here, divided by 360 multiplied by negative cost multiplied by negative cost of sales for 2024, and then we copy that to the right. And then we do the same here, divided by 360 multiplied by negative tax for 2024. Okay, and then we copy that to the right. The same here. Right, so here we can add a top border, and then here we can add a top border as well. So here we are saying current assets minus current liabilities, and then we copy that to the right. And then when we come here, we want to find changes in operating working capital items. So we are saying this minus this. So the operating working capital figure for 2024 minus that for 2023, and then we copy that to the right, just like that. Okay, now we have to link that through into the cash flow statement. So to do that, to link the changes for inventories, we say negative equals, right? We open bracket and we go back to the working capital schedule, and we select the figure, inventory figure for 2024. We subtract it from the 2023 figure, and then we cross brackets, right? So here we say negative, and then we do the same for receivables. So we select receivables, and then we subtract this figure here, and then we say equals, right? And then we do the same for, now notice that we are not starting with a equal negative, we're just starting with equals, then we open brackets, and then we go to working capital, and then say minus this, right? And then we copy that to the right, and we do here, we say, we go back here and say this minus this, and then we copy that to the right. Okay, and then we copy that to the right. So here you can see that this one is similar to what we got here. So it has to be in, if you see your figures here that in negative format, to see if you have done correct, they have to be positive in the cash flow statement. Okay, so now I think we can add a border there, right, like that. Right, so what else can we do? Cool. So now let's just, okay, like that. That's changes in working capital, and that's also this plus this. Okay, so here for now we can just copy the formula to the right. Okay, now I think and here obviously we get the changes. Here we say plus this and plus this, okay, and then we add a top line border there, okay, and then we also do the same here, top line border, okay, which is fantastic. Now here we have got cash flow before debt pay down. So that what this essentially means is that we take this plus this plus, so we don't add all line items in the financing activities section that is to do with debt, so we leave them out, okay, just like that. So here, since this is a formula, it has to be in black. Perfect. So now we are done with our cash flow statement. Some of these items we are going to link them through later. So we are going to link the interest income, interest expense later. I think that's the major one that's left. Even the proceeds here, we're going to work on this we're going to work on this later. So for now, let's proceed to the balance sheet. So here it is, guys, and see you in the next section where we are going to look at the balance sheet, how to project the balance sheet using the cash flow statement. So see you there.